Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at how Paramount buying the rights to UFC fights will impact its streaming service.
Plus, a look at earnings from the networking bellwether Cisco Systems.
But first, we look at third quarter earnings from the farm machinery leader Deere.
This week, Deere reported earnings that beat analyst projections, but the company trimmed its projected net income for 2025. This comes as customers remained cautious due to trade uncertainty and the health of the U.S. economy.
For more, Lisa and I were joined by Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst. We first asked Chris for his key takeaways from Deere earnings.
Listen, this really wasn't a particularly great quarter. 3Q results were mixed at best. It was really a low-quality earnings beat, primarily driven by a lower tax rate. And as you alluded to, they did cut their 2025 guidance. But to be honest, I don't think that really changes the investment thesis here. We still expect earnings to bottom this year. We're still looking at a very, gradual recovery as 2026 unfolds. The reduction in the outlook was really driven by weakness in their construction business. And it appears to us that it was really more of a function of some of the higher tariffs and costs coming through. We knew that construction and forestry was really going to bear the brunt of the tariff impact, but this quarter just came in, a little bit more of a headwind than we anticipated. It doesn't appear to be that there's been much of a change in terms of, farm fundamentals and their appetite to go out and buy equipment.
Hey, Chris, can you get more into the struggle that farmers are facing that's impacting Deere?
Sure. We've been in this kind of prolonged downturn in the ag economy. Crop prices continue to deteriorate. Farm fundamentals remain weak. Interest rates remain high. We have the overhang or the uncertainty around the trade environment and export market access. Really, there's really no signs, or I would say green shoots yet that we're at this inflection point. I think the positive takeaway is that, inventories are coming down. Deere's not going to have to massively underproduce retail demand next year. So even if we're looking at a flattish type of environment in terms of underlying retail demand, we're still looking at probably higher production and some pricing coming through, which should still generate some operating leverage in the business.
So, Chris, when demand is down for their core farm equipment, what does Deere typically do? Do they let inventories build? Do they get promotional to move inventory out the door? How do they usually manage that?
Yeah, so it's a delicate balancing act, right? It's almost impossible to time the cycle. And what they've been doing, for the better part of this year and even at the end of last year, they had been underproducing retail demand to bring down those elevated inventories. They've done really a commendable job on new equipment. The big issue right now is still on the used equipment inventory side, particularly on tractors, which are still quite elevated. And you're right, they are allocating more merchandising programs and pool funds to help address that issue and move the equipment. And I think you see that partly reflected in their production precision ag business this quarter, and pricing actually flipped negative, which was a surprise to us. It does appear that this is, relatively transitory. We should expect pricing to bounce back next quarter. But yeah, it's been they've done a real good job of managing inventories. It's just, when you're slogging along through the bottom of the cycle here, it does become quite challenging.
So then I got to follow up. Are you still cautious about the pace of their recovery?
Yes. I would say signs of recovery are still, pretty elusive to us. And if you just look over the last couple months, you continue to see further downward pressure on crop prices, which at the end of the day is one of the bigger drivers of Deere's business and farmer cash receipts. We had a pretty ugly WASDE report this week. It looks like we're going to get another year of record corn production. So those stockpiles continue to build, which is really going to keep somewhat of a ceiling on crop prices here in the near term. So we think this recovery is going to look much more modest or subdued than what we typically see during a normal cycle. right now we're still anticipating, a modest, flat to up 5% next year in terms of underlying retail demand for large ag, particularly in North America.
Our thanks to Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
We move next to a conversation about the global fintech company Nayax. Nayax trades on the NASDAQ under the ticker NYAX.
The company is focused on payment software and devices for the self-service space where no cashier is present. And the company recently reported second quarter profit that more than doubled analysts' expectations.
This week, guest host Norma Lind and I were joined by Nayax Chief Financial Officer Sagit Manor. And we began the conversation by asking Sagit for more background on what Nayax does.
So we are actually the global leader in payment and management solution for the unattended market. And what does it mean unattended? It's really the vending machine, massage chair, EV chargers, when it's just you in front of the machine. There's no cashier in between. And in fact, if you bought a drink in a vending machine lately at the JFK, you probably used one of our Nayax yellow devices. So we have more than 100,000 customers. We sell our product in more than 120 countries. And we have a very simple mission statement to help our customers grow their business. What does it mean? Increase their revenue, decrease their cost, and through loyalty, create that stickiness with our customers, with their customers.
How do you stay ahead in today's fintech landscape? Of course, there's a lot of players now.
So actually, in our area, there's not a lot of competition. I'm talking about the payment and in the unattended space. So in fact, we are the only global, as I said, player in this unattended space. It's a very fragmented business and decentralized. So there's a lot of small players. And we are, with our global solution, basically integrated hardware, payment, and services all together, we can bring that to the local market. It's also a very highly regulated market, so there's a lot of barriers to entry. So whether it's a regulation on payment, whether it's privacy, and with our global solution and with us being there for 20 years, we were able to overcome that. We look at ourselves as a payment company, and what do you need as a payment company? You need basically three things. You need the trust, you need the scalability, and you really need the easy doing business. So from a trust perspective, we built that trust over the 20 years. We have a very strong brand. Look now for the yellow devices. You will see that everywhere. From an easy to do business with, it's a B2B2C. So we have a very, it's a high profile company. You go to, whether it's the car wash to the vending machine, and you see us. So B2B, it's all about regulation, and we were able to overcome that. When it comes to B2C, as I said, it's in front of us, and you want that in a nanosecond to get your snack, to get your coffee. So on the scalability, this is where we are focusing, right? This is what takes time to build. And we've showed that we are using more than 80 distributors all around the world, right? So we are selling our product straight to the OEM. So when the vending machine, the massage chair, the kiddie ride are coming from the manufacturers, It will already bring that Nayax device.
Talk to us about the EV business, electric vehicle business. How are you guys approaching that? What is your expectation for how that business will grow for you?
So, great question. EV is definitely one of the three main growth drivers as we look into 2025 and even beyond. There's a few elements there. It can be as easy as any unattended verticals that we're already in. We're already working with the EVgo, Electrify America, Electrify Canada, where we are providing the payment device. But it can also be where we are developed the management suite, the electricity management suite that has a lot of regulation around it. And we were able to accommodate that as well. And then for small businesses, which I haven't mentioned that, but most of our customers are small and medium businesses. That's where we provide the whole solution, the hardware, the management, electricity, basically, as well as payment. So EV, we just announced the agreement with Hotel, which is a potential of 100,000 EV charging stations to be deployed in North America and also in Europe. And many other contracts like that shows the potential with the fact that we are a global company, so it can be done in France or in the state of California, and you have the same exact product all around the globe.
Mm-hmm. Are there any particular market gaps or audiences that are underserved that you're targeting right now?
So in the unattended space, which is the majority of our revenue today, definitely there's a place on the EV to grow. The electric vehicle chargers, smart coolers is a very fast growing area, parking as well, micro market. So this is in the unattended, but we also are stepping into more of areas like, as I said, the EV charger that is beyond the payment, or even the retail. What we've learned over the 20 years that we're doing business with small businesses is that they're still in the attended, inside the store, inside the whatever it is that you're selling, there's not a good product for those small businesses. And we are expanding that into other countries as well.
Our thanks to Nayax Chief Financial Officer Sagit Manor. Coming up, a look at where we are with robo-taxis in the U.S. and the rest of the world.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
We move next to some news in the media and entertainment space.
This week, we heard that Paramount has acquired the exclusive rights to show all events from the Ultimate Fighting Championship in the U.S. over the next 7 years. It's a $7.7 billion deal designed to boost Paramount Plus streaming service.
For more, Lisa and I were joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media. We first asked Geetha if the UFC can be considered a good deal for Paramount.
No one saw this coming. The Paramount Skydance transaction just closed last week, August 7th. And we were still kind of waiting for some inkling of what the go-to strategy or the go-forward strategy would be from, David Ellison's team. And here you go with a bang, paying almost $8 billion for UFC rights. Now, they are premier sports rights. So they're definitely making a big statement here. Yes, you're absolutely right. UFC has over 100 million fans in the United States. Their current deal is with ESPN. They were getting paid about $500 million a year. So this is, more than 120% surge. So it is definitely a pretty penny. And what Paramount is hoping is that this really gets them onto the sports arena. So makes them a must-have platform. And we're talking here about Paramount Plus, which is their streaming platform, which is known for really some great scripted content and some sports. But this is really a big way for them to kind of make a statement, make a really bold splash on the sports streaming stage.
All right, Geetha, I'm trying to take this in stride because my husband is a big UFC fan. So he watches it on ESPN. So does this mean that I have to get Paramount Plus on top? Don't tell me that, Geetha.
Sorry, Lisa. Yes, you do. Because everything, all of the UFC content. So what we initially thought was that UFC was kind of going to split these packages. They have the fight night, which is the weekly, bi-weekly kind of, matchups that you see. And then they have their big marquee events, which are the numbered events with, the likes of a Conor McGregor, all these other big superstar players. And you got to pay out of your pocket for that pay-per-view. They're actually now making all of that content, both the marquee events as well as the fight nights, all available to Paramount Plus subscribers. So there's no pay-per-view anymore. But yeah, unfortunately, your husband's going to have to subscribe to Paramount Plus.
Thanks.
Well, this is what I think you do. Every streamer you put on, you have to take one off. So go to the family. Okay, we're putting on Paramount Plus.
Yes.
What are you giving back?
What are we giving back?
Yep,
okay,
exactly.
Like
That's how you do it.
Thank you.
Geetha, what is realistically the bull case for Paramount Skydance Corporation?
Yes, I think, we really need, of course, this kind of tells us that they're definitely going to keep the streaming platforms. See, some of the concerns, Paul, before the deal actually closed was what is Skydance really interested in? So they don't really have any expertise in running TV assets. All that they really cared about was the Paramount studio, because, Skydance is a big studio and they were really, really interested in the studio asset. So we really didn't have any direction in terms of what they were going to do with the cable networks. Viacom has a bunch of those. You have the CBS broadcast network. You have the Paramount Plus streaming platform. What this deal signals is they're definitely interested in the streaming platform and the CBS broadcast network, because they did say that they're going to simulcast some of those UFC games on the CBS broadcast network. So I think that is going to be a core part of their portfolio. What we're still not clear about is what they're going to do with some of the cable networks. So, whether it's a BET or an MTV or a Comedy Central, we really don't know what the strategy is there. Chances are they might look to monetize those assets, sell them. But really, I think the big play for Paramount is going to come down to make these bigger and bigger investments. If they really want to be a credible, streamer, they have to obviously go after these big deals, which is exactly what they did with the UFC. We'll have to wait and watch and see exactly what their aspirations are. But it depends. If they're willing to kind of make these big investments, they could become, arguably one of the top 3 or one of the top 4 platforms.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
We move next to an M&A deal in the apparel space.
This week, we heard that the Canadian clothing company Gildan Activewear agreed to buy the U.S. underwear maker Hanesbrands for about $2.2 billion in cash and stock. Gildan is aiming to double its annual sales with the transaction.
For more, guest host Norma Lind and I were joined by Abigail Gilmartin, Bloomberg Intelligence Footwear and Athleisure Analyst. We first asked Abigail to discuss who Gildan is and why they're buying an underwear company.
I think a lot of people probably own Gildan and don't know it,
right?
Because it's really a basic apparel manufacturer. So they create the T-shirts that then they sell to your favorite sports teams or to Walmart, and then they put the logos on it. So they're heavily in the printwear space. They do have exposure to innerwear, which is what Hanes is. Hanes is, the basics, underwears, bras, tees, and they used to be in activewear till they spun off Champion. So they're very complementary. Yes, they spun off Champion about a year ago.
Okay.
Interesting. And I definitely remember Gildan, as you mentioned, when you just start to look into the tags of your T-shirts, you'll start to see the name pop up there. But I mean, what's the latest with consolidation more broadly in your industry? I know you have a lot of names that you cover that are doing a lot of mergers.
Yeah, definitely. I think, it comes at a time with tariffs and costs looming, as well as, for this acquisition, I think it's been considered for a while. There was a whole proxy battle about it a few years ago where they actually ousted the CEO over it. And then he has returned since then, and they completely changed the board over. So this didn't come completely out of nowhere, but I think it makes a lot of sense just in terms of, Gildan's building out their whole manufacturing footprint. And it's, once again, really complementary. They already kind of make everything that Hanes does, but on a larger scale at a lower cost.
And Hanesbrands based in Winston-Salem, North Carolina.
Yeah.
Interesting. Talk to us about, you mentioned the tariffs. How is it impacting your world? Because I would think that would be immediate.
Yes. So it definitely is impacting my world with, the footwear brands. But for Gildan and Hanes, actually, Gildan is one of the largest users of U.S. cotton. Really? So, yes, they are probably one of the largest ones. And so that is actually going to help them not have to deal with as many tariff costs, just since products are made with U.S. cotton. So they're subject to a lower tariff rate. So that's actually something that they can benefit from. They also are less exposed to Asia and more in Central America, as well as Hanesbrands. Their manufacturing footprints are very complementary and overlap. So they'll be able to kind of mitigate that pretty well. But for Hanesbrands, Gildan gives them a much more financial stability and opportunity for that.
Our thanks to Abigail Gilmartin, Bloomberg Intelligence Footwear and Athleisure Analyst.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agriculture sectors.
This week, we looked at the autonomous vehicles robotaxis. Guest host Norma Lind and I were joined by Andrew Grant, BNEF Head of Intelligent Mobility.
He discussed what's happening in the robotaxi space and some of the hot battlegrounds for developers.
I began by asking Andrew where we are with robotaxis in the U.S. and the rest of the world.
Wouldn't it be a great way to have a way to measure how the progress that we have on the robotaxi side and the self-driving vehicle side? Sometimes it can be quite difficult to monitor the sector, and there's a lot of promises made, and there's a lot happening in the kind of AI black box. And what we try to do is measure things that you can actually see and count. So we've been looking at some real operational statistics that have been coming out from some of the robotaxi companies, and coming up with a way to grade how serious an operation is. Are these projects actually operating on public roads? Are they offering their rides to the general public, or do you need to be on a selective wait list? Are they putting their money where their mouths are and charging a fee for the service? Do they actually have a safety driver in the vehicle, or humans still supervising in the vehicle, or have they pulled that? And are they able to operate in all weather conditions 24 hours a day, 7 days a week? And if they kind of score a 5 out of 5 in our grade, that's a fully functional operational robotaxi service. We count about 8 of those operating in different cities around the world. I should say around the world. At the moment, it's just China and the US.
Okay, so we're seeing China and the US as the two leaders here?
Yeah, at the moment, we have kind of 4 companies that have met those grades. We do have another 16 projects that are kind of 4 out of 5 on our ranking metric there. I should mention that Tesla just gets 2, but a lot of these companies are looking to expand outside their home markets, certainly expanding to places like Singapore, the Middle East, and the UAE, and then of course Europe, which at the moment there's regulations that are kind of preventing a wider spread rollout of robotaxis, but a lot of these companies are targeting 2026 for deployment across a number of European cities.
So who are the leaders here at this early stage?
I mean, really, you're talking about Waymo with the most projects that meet our grading of fully operational robotaxi services. But from the Chinese automakers, the China robotaxi developer side, you're also talking about Baidu, WeRide, Pony AI that are scoring highly on these metrics and looking to expand.
What are some of the regulatory hurdles here? Are there any areas in particular in the United States where it's a bit more open season?
It's a very complex regulatory environment at the moment, because you can kind of have these national or federal level ambitions, but really it comes down to not just even state level, but down to city level, where you need to work really closely with a lot of these regulators to deploy these services in a tightly geofenced environment. So you need to be actively, if you're a robotaxi developer, you need to be actively talking to a lot of these regulators and helping them understand what you're trying to do and how you're trying to complement what they want to do on the public transport side or on their transport infrastructure side to make this work and make it a valuable project for both entities. So I always describe the regulatory environment. It's very iterative. You kind of need to tick one box, prove to your regulators how you're doing, and then continue to grow that relationship and kind of build the regulations with them. And a lot of knowledge exchange needs to happen as you progress.
Yeah, I'm just looking at your self-driving vehicle tractor at www.bnef.com. Have to be a Bloomberg terminal user, I believe.
Yes.
But very, very cool. It's an interactive kind of model showing you where around the world. So what are the gating issues here, Andrew, for fuller and fuller deployment going out over the next several years? Is it regulatory? Is it technology? Is it capital? What are the key drivers for just, I guess, adoption over the next several years?
I mean, we talk a lot about the technology and the regulatory side, and both need to improve, and I think both will. What's probably doesn't get enough attention, and we're starting to see a lot more focus on that at the moment, is just the value chain really starting to take shape. Building a car, building the software and the related hardware that goes into powering a self-driving vehicle, matching the vehicle with users, owning the vehicle. These are all things that have different skill sets from a company perspective. They have different capital requirements, and they have different payback periods. So we're starting to see different roles form in this part of the value chain. And you're seeing the many deals that, say, Uber has signed over the last 18 months. They've signed deals with at least 10 different self-driving vehicle developers across the taxi and truck space and the delivery bot space, I should say, as well. And they're really trying to put their best foot forward, or to borrow the Jeff Bezos expression, just focus on what makes the beer taste better and really specialize in the different areas. So we're really starting to see a more robust and definitive shape form for the robotaxi value chain.
Our thanks to Andrew Grant, BNEF Head of Intelligent Mobility. Coming up, an in-depth look at Treasury Secretary Scott Bessent and his role in the Trump administration.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
We move next to news from the networking bellwether Cisco Systems. This week, Cisco reported fourth quarter earnings that narrowly beat analyst expectations.
The company also gave a forecast for the current fiscal year with sales between $59 and $60 billion. That's roughly in line with analysts' expectations. And the lukewarm forecast disappointed investors who hoped for a boost from massive AI data center projects.
For more on this, Lisa and I were joined by Jin Ho, Bloomberg Intelligence Senior Technology Analyst. We first asked Woj for his takeaways on Cisco earnings.
At the end of the day, the guidance was a reminder that they are still tied to IT spending. And, I viewed it as more as prudent conservatism because they don't know what's happening on the second half of the year, given where we are, where we have little visibility in terms of rates as well as tariffs still.
So the company recognized about $1 billion in AI revenue in fiscal 2025. And I guess AI infrastructure orders from large cloud providers were over $800 million in the quarter. So where do we think these numbers can go?
Yeah, look, Paul, they forecasted $1 billion in orders for fiscal 25. They doubled that in fiscal 26, recognized $1 billion of it this year. I wouldn't be surprised if AI revenues grow at least another 50% from here. And they're penetrating multiple pockets, right? Not only into the cloud, but if you think about it longer term, when enterprise adoption really starts kicking in, there is going to be a growth driver. So we have to see where it'll be in 26 and 27 when enterprise grows. But the partnership with NVIDIA should be beneficial to them longer term.
Well, is the AI sector, is it just too competitive? I mean, who are some of their peers? How are they doing against them?
Well, if we think about it, well, they have multiple, they're in AI in multiple vectors, right? So from a networking space, Arista is one of the bigger competitors, as well as a smaller company called Celestica. They're also very, very big on optical components, and they're coming up against companies like Marvell, as well as Ciena. And they also provide AI servers, and think about Dell and HPE. So look, is it competitive? Yes, but they're one of the few American vendors that can actually supply components all the way to the system hardware.
Woj, what are companies like Cisco and Dell and some of the other big American companies throughout the tech stack chain, what are they saying just about the environment in terms of demand from their customers? Are they sensing waning demand or wavering demand just to see how some of these, tariffs or other economic policies may work out?
Sure. Paul, Cisco is one of the first hardware bellwethers that came out. I will tell you from the numbers that I've seen on the companies that have reported, the IT spending environment has actually been more resilient than I had thought. I went into the quarter with my mid-year outlook as being a little bit cautious and negative. And quite frankly, the results have come in better than I had anticipated. The outlooks have come in better than I anticipated. But the fact of the matter is, I don't know what's going to happen past December. And I think Cisco's guidance reflect that. We'll have a better sense in a couple of weeks from now when companies like Dell and then HPE after Labor Day, when they report.
Did they talk about their guidance at all about the impacts? We mentioned tariffs quickly, but did the impact of tariffs? If so, how do they intend to lessen that impact from tariffs?
Cisco has been probably one of the better companies in terms of managing expectations of tariffs, as well as maneuvering the supply chain with the tariff. So in terms of managing expectations, they embedded tariff impact in their guidance. And because tariffs came in a little bit lower than we had anticipated, that actually helped EPS just a little bit. Going forward, all of the guidance includes the tariff impact. Now, the one thing I will add, we're still waiting for the semiconductor rulings as it relates to Section 232. We'll see where it stands. If we do have a negative ruling there, that could not only affect Cisco's guidance and margins, but also the rest of the electronic space.
Our thanks to Jin Ho, Bloomberg Intelligence Senior Technology Analyst.
This week, we focus on a Bloomberg Big Take story entitled Scott Bessent on Tariffs, Deficits, and Trump's Economic Plan.
You can find it on Bloomberg.com and the Terminal. It's also the cover story this week for the Bloomberg Business Week magazine.
The story looks at how U.S. Treasury Secretary Scott Bessent has the ear of President Donald Trump and why nervous investors worldwide hope it stays that way.
Bloomberg's Erik Schatzker and Daniel Flatley co-wrote the story and were part of the team that recently interviewed Bessent.
Earlier in the week, guest host Nora Melinda and I were joined by Erik Schatzker, editorial director for a Bloomberg New Economy. We began the conversation by asking Erik for his key takeaways from the Bessent interview.
Well, first of all, the man is unbelievably busy.
Yeah, I can imagine.
Spent a day at the Treasury Department with our colleague Dan Flatley, and to observe how much he gets done in the course of a day, including spending an extended amount of time with us, gives you a window into the life of the Treasury Secretary in the Trump administration. And it's important to emphasize in the Trump administration because this particular Treasury Secretary has been given a whole host of responsibilities that go beyond that of the typical Treasury Secretary. We know that the Treasury Secretary in any administration is involved in tax policy, is involved in economic sanctions, is involved in financial regulation and the like. But President Trump has tasked Scott Bessent with trade negotiations, with striking, and not just any old trade negotiations. China, perhaps the most difficult trade negotiation of all. Japan, which was successful. South Korea, which was successful. Indonesia. The list goes on. He's also the acting IRS commissioner. He also crafted the very novel and original deal that the United States struck with Ukraine for a share of that country's mineral resource wealth back in April. These are not, and furthermore, I have to add, he was instrumental in getting the One Big Beautiful Bill through opposition among Republicans in both the House and the Senate in order to meet the president's self-imposed July 4th deadline. So Scott Bessent has taken on way more than your traditional Treasury Secretary does, and much of that is because the president himself has asked him to do so.
Mm-hmm. And it seems as though a lot of people see Bessent as really having the president's ear here, and this is a really fantastic story, by the way. What was the most surprising element through your conversation with him?
Oh, there's so many surprises. I would say that the thing I didn't fully appreciate, and which he spelled out for us and which others spelled out for us, is the degree to which this is something he sought after, going back many years. Bessent told us that he thought about joining the Trump campaign as early as 2016. But at that time, he just started a new hedge fund, Key Square Group, and he didn't feel like he could abandon his employees or abandon his clients. But what he did do was start to get to know the people close to Trump almost immediately thereafter, starting with Steve Bannon, and subsequently Peter Navarro, Stephen Moore, Kevin Hassett, for example, Trump's close economic advisors, Art Laffer. He went down to see Art Laffer in the South, made a pilgrimage of sorts to get Art Laffer's blessing for his ambitions to become Treasury Secretary. And these he didn't make known to Trump until November of 2023. So it was almost a 6-year period in which he was maneuvering to position himself for a shot at Treasury Secretary. And when he saw Trump in that November 2023 meeting at Mar-a-Lago, Trump asked him if he wanted the job, if he was interested in being Fed chair. And Bessent said, no, I have another job in mind.
Very good. The Street, Erik, gives Scott Bessent a fair amount of credit for walking the president back from maybe some of the more difficult tariffs that were initially announced. Is that a valid point? Did Scott Bessent play a big role in walking the president back a little bit? And does he take credit for that, or is he kind of demure?
Bessent insists that his job is not to explain things to the president or to advise the president. It is to present the president with a series of options. Here's path 1, here's path 2, here's path 3. And I will explain to you where we get if we go down 1, if we go down 2, or if we go down 3. And he leaves it ultimately for Trump to make the decision. That's I wouldn't say that's unique to this president, but Trump has a very particular view of his role as the decider-in-chief in this administration that is perhaps different from what we saw with Biden or with Obama, or even going back in history to other Republicans like George W. Bush and maybe even Ronald Reagan. So Bessent does not claim credit for being the de-escalationist, but it is clear, talking to people around him and to understanding how the market thinks, market psychology, if you will, which is, one of his areas of expertise, having been a macro hedge fund manager for almost 40 years, that is where it really counts. The market trusts him, and the market, based on its observations, draws these conclusions, rightly or wrongly.
Did he share any concerns he may have about just getting somehow involved in some of the crossfire that happens around President Trump and getting into President Trump's bad graces, or just kind of, because it's such a perilous... Those people that fly close to President Trump historically have done it at their own risk, including the former vice president. So how does he negotiate? Does he even acknowledge that that's a risk?
What I divined from the conversations we had with the Treasury Secretary is that there is a formula for success in the Trump administration, and it means making certain compromises, if you will, with yourself. You can come in with your own ideas, but it is not your job to advance that agenda.
Right.
So you have to make some compromises. If you don't, and Steven Mnuchin, the former Treasury Secretary, points this out, if you cannot represent the president well, in other words, if you can't get behind what the president wants, the role has no power. What's the point of being in D.C.? What's the point of abandoning a 40-year career in finance where you rose to be one of the most successful hedge fund managers and have, for it all to be worthless, have to have no power? No, you want to be able to wield influence and get things done, and that's very much in the back of Scott Bessent's mind. What's my legacy as Treasury Secretary going to be?
Our thanks to Erik Schatzker, Editorial Director, Bloomberg New Economy.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.